This segment is sponsored by Dennis Goins of DennisGoins.com. I'm Lady Charmaine, and I'm back with financial advisor, Mr. Dennis Goins. How you doing, Dennis?
I'm doing fine, Lady Charmaine. How are you?
I'm good. And today, Dennis, we're going to be talking about tax strategies for retirement plans. Now, I wanted to know, why is it so important to have a tax strategy for when you retire? Because I never really thought about that, but why is that so important?
Well, as I've mentioned several times before, it's not how much you make, it's how much you keep. And one of the things we're going to talk about today is what is the most tax-efficient way to take distributions from your retirement plan. And obviously, if you receive a distribution from your 401k or a profit-sharing plan, you need to consider whether you pay taxes now or to roll that money over into another tax-deferred account. And, of course, you basically have to complete that in a correct manner and a tax-efficient manner to allow more money to come into your bank account. Now, there's one way you can take it, is you can take it in a lump sum. Now, if you decide to take a lump sum distribution, the income taxes are due on the total amount of the distribution in the year you take the money. One of the things about that's very certain is death and taxes, and the IRS will definitely get their money from that distribution. And employers assist in that matter, because if you take a lump sum distribution from your 401k or profit sharing plan, the employers are going to take a 20% withholding and forward that money to the IRS on your behalf. So in other words, you only get 80% of the money that goes into your bank account. So the advantage of taking a lump sum distribution is that you can spend or invest that balance as you wish. You can spend it now. The problem with that is you're parting with all those tax dollars. So in some cases, that might not necessarily be the most efficient way of taking that lump sum distribution for your taxes. Income taxes on the total distribution are taxed at your marginal tax rate. So as we know, we have a marginal tax system. So the higher money you make, the more proportionate is your income. So this lump sum distribution could probably put you in a higher tax bracket, which makes even less of a money that you'd have to pay or realize upon the distribution, not only on that, but everything else. And also, if you take it before 59 and a half, you're subjected to an additional 10% penalty.
Ooh.
So yeah, that, again, it goes with a lot of planning. It's not how much you make, it's how much you keep. Now, on the other hand, obviously that's very painful as far as taxes. Another alternative to that, if you don't want to pay the current taxes, is you can roll that money over into an IRA. You can roll it over into a traditional IRA, and that money is basically tax deferred. So whatever money you put in there, 100% of it goes into the traditional IRA if you do a trustee-to-trustee transfer. And that's usually a lot. What I advise a lot of my clients to do is, if you're not, even if you need the money, roll it over into an IRA, a traditional IRA first. Then if you need it, take the money out of that traditional IRA. Why? Because you avoid that 20% withholding that the employer allows. So if you basically roll it over in traditional IRA, then obviously there's no taxes due until money comes out. Or you can roll that money into what we call a Roth IRA. If you put it into a Roth IRA, you pay the income taxes on the amount of money that you put in there, although future withdrawing of earnings, not basis, but earnings from the Roth IRA are free of any federal income tax after age 59 and a half. And that's provided that you keep that Roth IRA for 5 years. And that's something new that started about 2 years ago, where you can roll that money into the Roth IRA and not have to pay taxes as long as you keep it 5 years or more. And the good thing about the Roth, the amount that you pay taxes and put in there, you can pull that money out any time without any penalty and or taxes. It's the earnings that you have to keep for 5 years, and that can be kind of confusing. A lot of these laws and a lot of these provisions are very confusing at times. And of course, the IRA rollover allows you to let that money continue to compound for you and grow on a tax-deferred basis. And of course, if you keep money in the IRA, you have to. Now, again, the IRS, the government has not gotten their taxes. So once you're at 70 and a half, and this is very critical, once you're 70 and a half, you have to start taking money out of that IRA. And that's why you need to consult your tax and your financial advisor to assist you in that matter. And of course, the key thing, again, is about tax efficiency. And of course, the last option, and this is an option also, you can roll that money into a new employer's 401k plan, and there's some advantages to doing that. And of course, you can just leave it if the employer provides the permission. You can leave it where it is in the 401k and not roll it over or not. So before you decide to make any distribution, and the government's very, very critical about this now, because making sure, because now the onus is on the employees to decide on how their retirement's going to work. And those are options that you need to, for each individual, there's no one size fits all. Each individual has to decide their own specific situation, determine what's the best option. Whether you distribute it, spend it, whether you roll it over, or you keep it where it is, or roll it into the new employer's plan.
Now, that is a whole lot to think about. I was listening to everything you were saying and how to move the money and you know, what age you should get the money and the best time to be able to get the money. Do you have people that are a lot like me that's just like totally oblivious? I don't want to say ignorant, but you know what I mean? Just about money. There's so much we need to learn about money. And that's why people like you is so important. Now, I know this is off task. What made you even want to become a financial advisor to help people such as myself and the listening audience?
Well, my first event, and I work pretty much with the middle market, and a lot of my clients, you know, basically don't really understand the premise of stocks and bonds and some of the financial instruments, and even now, the majority of my clients are in 401ks. So obviously they have this 401k and they have this retirement vehicle, but a lot of them don't really know where to put the money. And as I've talked about before, you have to buy low and sell high. Well, a lot of people just don't understand that, and they've kind of put out there in the market and don't really understand and know what they're doing. And their retirement future is pretty much dependent on them. So they're kind of led astray and left out there. So my intrinsic, my wanting to help people basically know in the middle market on how to manage your 401k. That really is what my mainstay is in the market, and that's why I really enjoy what I do.
So if people wanted to talk to you more about this, because they just have questions like a person like me to say, you know what, Dennis, I don't know anything, and I know I'm getting close to retirement age, and I need some help with my finances and just more so how to make investments, where can they find you?
Well, they can find me on my website at www.dennisgoins.com. And, of course, so they can email me at dennis@dennisgoins.com. And they can also find me on my Facebook page at Dennis Goins and Associates, and also at LinkedIn at Dennis Goins and Associates. And, again, they can go on YouTube and also get some of the segments, this segment and any of the previous segments that we've had, and get some of this information, because this is very critical now. I mean, some of the things we're talking about is very critical as far as a person's retirement future, and now it's now in your hands to make sure that you're successful there.
Amen. And I want to thank you so much again for sharing all this information. It is truly, as we call it, a wealth of knowledge. So I want to thank you so much, and we look forward to talking with you on next week.
Very good. Thank you very much, Lady Charmaine. Have a great day.
Thank you for listening. If you would like to learn more about financial investments, contact Dennis Goins at dennisgoins.com.